Okay, this is the end of stock review. Okay, this is a question that was asked to me about currency risk, right? So this is one of the questions asked to me, but quite commonly asked. Okay, so for many years, as you know, the US dollar has been weakening, right? Okay, it has been weakening for some time already. Okay, let me adjust my PowerPoint slide. Yeah, okay. So it has been US dollar has been weakening for some time. So it used to be like 1.7 in the 2000, early 2000, and now it's 1.3. So the downtrend is concern for those who want to invest in the US market, and they are worried about the USD will continue to fall. So one of the questions asked is that, is USD a weak currency? So is investing in US market still sensible in a declining dollar? Should we avoid period where US central banks are cutting rates? Can we hedge away currency? So these are the questions that I will address later. First, is US dollar a weak currency? So when we talk about currency strength or weakness, right, it's always relative to another. Okay, it's always another currency or relative to a basket of currency. So in the case of US dollar, like the short answer is no. It's not one we consider a weak currency, because over the past 20 years, right, US dollar has actually appreciated against many of its developed peers like the euro, the pound, the yen, Aussie, and Canadian dollar. So it's not that the US dollar is weak, but rather Sing dollar is too strong. Okay, the reason why why we have a strong Sing dollar is because the Monetary Authority of Singapore, MAS, manages Sing dollar within a band against a basket of currencies from our major trading partners. So this helps to control inflation and stabilize the economy. A quick look at Sing dollar performance over the past one or two decades reveals that most currency, including those of many developed and Asian nations, have actually depreciated against the Sing dollar. Only exceptions is the Swiss franc. Therefore, US depreciation against Sing dollar isn't unique. Okay. Now, is investing in the US market still sensible? So currency risk is part and parcel of international investing. So while weakening currency can reduce return, what really matters is the long-term performance of investment. So the key question is that, do the numbers still hold up after accounting for currency movement? So if the underlying investment is still strong, temporal fluctuation in exchange rates have a limited impact on overall outcome. So to have a better sense, right, let's look at how the stock market returns are compared to Singapore stocks market over the past 20 years. So this slide here is the annualized return using MSCI indexes, and also it's been normalized, converted to US dollar for apple to apple comparison. So if you look at this slide, right, despite the depreciation of this currency against Sing dollar over time, almost half highlighted in yellow outperformed the Singapore stock market. So you look at this Singapore stock market, 7.2% annualized return for the past 20 years, right? But there are many those highlighted in yellow did better than Singapore. Okay, despite the fact that they depreciated, those currency depreciated against Singapore. Okay, this suggests that even there are headwinds from currency fluctuation, right? Strong underlying market fundamental is still important. The next is this, that it's very unfortunate that very strong companies are not listed in Singapore. So investing in Singapore stock can be an alternative for those looking to avoid currency risk, but the strong companies are not found in Singapore. So if you look at the top 30 companies of the S&P 500, they have a return of capital exceeding 20%, some even reaching 30%. Look at this. These are all very strong blue chip companies, right? And you know, they have, like, many of them have more than 20% or even 30% of the return on capital. In contrast, right, the same ROC for companies in the Straits Times Index, which is the top 30 companies in Singapore, tend to be much lower, often in the low teens or even negative value. Look at all these value, right? They are actually so low, you know. in their return on capital. So avoiding currency risk by investing in companies with low or negative growth, right, would only make things worse. Okay, the next consideration is the source of revenue. Okay, because many MNC, like for example, like Apple, derive their revenue from multiple sources. For this example, Apple derives less than half of its earnings or revenue from US. The bulk comes from the European market, 17% from China. So just because Apple is listed in US doesn't mean that the sole currency rate is US. In this case, right, the currency movement of the renminbi and euro do matter. Give you another example of ASML, right? ASML is listed in US dollars. However, US only account for 11% of revenue because most of its customers are outside of US. Right? You can see most of the customers are US, and this is a well-known fact, right, that most of the manufacturing foundries are not located in US. So really for the currency risk of ASML is largely non-US based. The next question that many of you have asked me is that if there's a investment that one in Sing dollar and another in US dollar, right? So does it mean that if you buy in US dollar, you're going to get currency risk? The answer is no. Okay. So in this slide, right, you can see that okay, over 1 year, US depreciated against US actually fall by 4% against Singapore dollar. Okay, this is 1 year, 17 October to 16 October this year. Okay, the change in Forex implied a 4% decline, okay, against Sing. But if you buy, let's say, DBS, right, you can buy DBS on a local stock exchange, there's no currency risk, or you can buy DBS in US over the counter, okay, OTC, at 89, which is denominated in US dollar. Now, if you to convert the all into Sing dollar, you find that the returns are exactly the same. Okay, it's really exactly you expect that you'll be disadvantaged by 4% if you to invest in US dollar, but it turned out that the difference is not 4%, it's just 0.3, right? Yeah, it's only 0.3. In fact, you have a 0.3% advantage if you invest in US. But of course, I mean, this 0.3 is just noise. It's just it doesn't really have any material implication. Okay, next is this. If there is an investment that has two foreign currencies, does it mean that you should only invest in a strong currency? So again, it's no. So let's consider another case, euro. Let's add euro inside. So euro depreciated against the Sing dollar by negative 1.4. So relative to US, right, euro is a stronger currency. But if let's say you invest in LVMH, LVMH is listed in Euronext, and LVMH can be purchased in US through OTC. And yeah, so if you purchase from Euronext, it's in euro. If it's US, it's in USD. You find that the actual returns when you convert the Sing dollar is also almost the same. Because for a layperson, you may assume that since the euro has a 2.6% advantage compared to USD, you expect a difference of 2.6, but no, you don't expect. The difference is only 0.3 again. Okay. Yeah, so it doesn't really matter what is the currency you're investing in this case. Let's look at another example, Fundsmith Equity Fund, which many of you invest in. Fundsmith is another example because it has three currencies. It has a euro version, you have a USD version, and you have a pound version. Okay. So does it mean that your returns are all different if you have different currency? The answer is no, because all returns are exactly the same once you transfer back to Sing dollar. So if you look at this chart, right, these are in their respective currency. Yes, the return looks different. But if you to convert them all to Sing dollar, that means you have a Sing dollar, you buy the fund, and then when you sell the fund, you convert back, you find that the returns are exactly the same. Exactly. Okay. So it doesn't matter what currency you're investing in. It's still the same return, despite the fact that the fund has different currency. Then the question is that why the fund want to have so many currencies since it's all the same? Because it knows that investors always misunderstand, and they always thought that, if they invest in the fund that is in the same currency they are in, there's no currency risk. So it's just really to address the misunderstanding. And very unfortunate that many investors thought that, let's say you're a US investor, and you thought that if the fund is in US dollar, there's no currency risk. Of course, totally nonsense. But the fund house needs to sell their products, right? So they cannot argue with the customer. I'm your financial advisor, and I've been arguing with all you on this issue for 18 years. And nobody could actually understand. And even after you understand, 1 year later, you forget again. Am I correct? That's why I'm recording this video. I'll put it on the YouTube so that the next time you ask me, I'll show you this video. Right, the next question that some may ask, for those who are more savvy especially, will ask, should we avoid periods where US central bank are cutting rates if that lead to further weakening of the dollar? Okay, so the rationale of this question is this: many associate rate cutting with the corresponding weakening of the US currency against others. The assumption is that the lower interest rate, it generally makes the currency less attractive for foreign investors. But this relationship between cutting rate and depreciation of the US dollar is not so clear cut. You look at this table, right? Okay, this is a table of hike and rate cut. You look at just the rate cut, right? There are 1, 2, 3, 4, 5, 2, 4, 6 rate cuts in this example. And some of them, we expect the US currency to depreciate, right? But no, there are cases where it actually strengthens. Right? Now, how about hike? For rate hike, we expect the currency to appreciate. But there are cases where it actually, in all cases, it weakens. And I want to tell you the real reason is because the central bank in Singapore manages our currency. So it doesn't matter US is hiking or not hiking. What Singapore central bank are concerned of is our inflation. So if our inflation is very high, central bank will increase the strength of our Sing dollar so that our import can be cheaper. And the reverse is true when our inflation is low. Right? So we have our MAS here managing our currency. And therefore, whether this rate hike or rate cut will affect currency risk does not apply in Singapore. It will apply to you if you are not in Singapore. Okay, some of you you are living in Australia, right? And some of you are living in Malaysia. It may affect you because your home currency is not Singapore, and your central bank does not manage currency movement. Okay, next question that's been asked that is related. Can you hedge away currency risk? Okay, so hedging is a method to remove currency risk. So this is done by shorting the foreign currency. Now, this is a table to give you a real example of a unit trust called Fidelity America, where one is hedged and the one is unhedged. Hedged means that there's no currency risk, and this is unhedged, where the currency risk is purely USD because the underlying all USD denominated stocks. So logically speaking, if you remove currency risk and you know that US dollar has depreciated against Sing dollar over a long term, then the hedge version should give you better returns for all periods. So this is true if it's less than 5 years. If it's less than 5 years return, you'll find that all the returns is better than the unhedged version. But over 10 years, right, it turned out to be worse. Okay, so why? The underperformance of the long-term performance of the hedge class is likely and largely due to the cost associated with the hedge itself. It's no free lunch. The cost is the difference between the interest rate of the foreign currency and the local currency. So roughly our foreign currency interest rate is about USD interest rate on long term about 3% to 4%. Singapore is about 2%. So you're looking at 2% per annum of cost. Now, if if the depreciation against no, if USD on long term depreciate against Sing dollar by 1% per year, then the benefit of removing the currency risk will be wiped out by the cost of hedging. So that means the cost is likely to outweigh the benefit on a long-term basis. Therefore, hedging is not advisable. Next, conclusion for currency risk, right? So the conclusion is this, see the big picture, focus on overall returns. Okay, the returns is all that matters. Now, the strength of Singapore dollar isn't necessarily due to its weakness. It's because, the strength of the US dollar is not because of the weakness, but it's because Singapore dollar is just very, very, very strong, right? Now, hedging against currency risk can be costly. And what truly matters is not the currency you are transacting in, but actually the risk associated with the underlying currency. Okay, so this is what my conclusion for this section. Do you have any question? Let me see the chat. So David asked, why do we buy, let's say, the Japanese unit trust denominated in SGD? I don't think there's a yen denominated or rupee, or he also asked about India unit trust because I recommended to him India unit trust and Japanese unit trust. So he's asking why did I recommend a Sing dollar version, since I say that it doesn't really matter, currency, it doesn't really matter. The short answer is that actually there's no rupee denominated and Japanese yen denominated unit trust for this unit trust, okay? So a matter of, yeah. Then next question, he also asked me directly, is that David also asked, is it better to buy the US ETF listed in London? Because I saw there's a London listed ETF in iFAST now. So yes, so the advantage of, okay, firstly is that where you buy the ETF from, as I mentioned, unless there's hedging, it doesn't really matter whether it's in pound or in US. Okay, so let me clarify this. But there is some tax benefit if you to buy ETF listed in London. Okay, so the tax is lower there, so there's some taxation benefit. But you must also understand that there's also two issues. One is that the trading cost is more expensive. If I remember correctly, iFAST, sorry, I can't give you offhand, but I remember the trading cost is 2 times that of the US. So if you're a long-term holder, it doesn't really matter. But if it's a short-term trade, it does matter. And also some of the ETF that I recommend to you, some of them are for short-term only, like the silver and gold, all these are short-term, right? Yeah, these are all the short-term ETF. And liquidity does matter. So London tends to have less liquid lah. So to keep it in short, that for very long-term investment in ETF, London listed one is better. But if it's going to be short-term, because of the cost as well as the poor liquidity, then no lah. Okay. Then I prefer the US. The Quant Multi-Strategy ETF are all listed in US. We have asked the portfolio manager why they select US. And the answer they gave is because many of all the positions in the Quant Multi-Strategy are all short-term. So the liquidity need to be there. Okay, it need to be very liquid. And also it's cheaper there, cheap in terms of processing fee. So Yiping asked me if you buy, okay, you guys can't see all this question because it's been posed to me directly. Okay. Okay, so okay, Yiping asks, if you buy Japan unit trust, should we buy H or INH, say for short term? For short term, right, okay, it's hard to say where the currency is going. So really, for me, it's neutral. I'll go along with what is comfortable with customer in this case. Seriously, because I always go into argument. I'm very tired of arguing with you guys. So either or is okay. Because if it's 2 to 3 years, no, I wouldn't buy Japan unit trust for 2 to 3 years. Okay, I wouldn't, because unit trust is meant for long term. Okay, so in the first place, I wouldn't. But if it's going to be, yeah, so it's going to be long term. Okay, but you ask me H or INH, I'm neutral towards it because yen tends to have very low interest rate. So the difference in the cost in hedging, right, is lower than that of the US. So if you hedge, the cost is, I think the long-term cost is not very high, and you give you some peace of mind. Okay, so I'm neutral on where you go, but I wouldn't buy Japan unit trust for a short term. Luis, yeah, okay, yeah, thanks. Yeah, I did this whole section just for you, Luis. No lah, your question is always the same question that people ask me, right? So that's why I did a presentation. Okay, next, I'm going to the next.